So Warren Buffett bought more shares of Bank of America. Should you? Hey, I'm Felix and welcome back to my channel Fiscal Voyage. So in today's video, we're going to do a stock analysis on Bank of America because Warren Buffett bought more shares of Bank of America. So we're going to determine if it actually was a good move and should you follow in his steps and buy shares of Bank of America as well. But watch towards the end of the video because I'm going to provide you with a recommendation to determine is a buy, hold, or sell, as well as my recommendation and my overall opinion on the company. But before we start, make sure to look at my description because I have a link for a free ebook that I've written. It's about 15 pages long and it's 5 metrics that I look for before spending more time and researching specific companies. So I think it's very valuable that you go check it out. If you're new to the channel, make sure to hit that subscribe button because I do stock analysis kind of like this video. So I'm sure you guys heard of the Warren Buffett purchased more shares of Bank of America, and this is the reason why I'm creating this video. So Warren Buffett, as you see here from Business Insider, put in $800 million into Bank of America, boosting his stakes to over 11%. So you see here, Bank of America stock is down 32% this year, suggesting Buffett decided to add to one of his biggest holdings at a discount. We're going to determine later in this video if it actually is a discount at current prices. And maybe you could get it at an even better discount because as today, the Bank of America is down about 1%. So we're going to do a stock analysis of the company and see if it's actually worth a buy. I also wanted to note the Bank of America also just declared a dividend of 18 cents per share. This is very good because of the current situation and the fact that they were able to pay out the same dividend as previous. So that's very positive, and this was announced in July 22nd. All right, so let's start with analysis on Bank of America Corp. Ticker symbol BAC. Pretty sure you guys know the company, but it's an American multinational investment bank and financial service company. Is the second largest banking institution in the United States after JP Chase, and the 9th largest financial service company in the world by revenue. It services approximately 10.7% of American bank deposit and is direct competition with Citigroup, Wells Fargo, and JP Chase. So they're considered the big four. So let's look at the fundamentals for Bank of America. Revenue grew at a negative 0.16% from 2010 to 2019. And net income had an outstanding growth of 44.5% from 2011 to 2019. 2010 they had negative net income earnings, so I couldn't calculate the compounded annual growth rate. But from 2011 to 2019 they had outstanding growth. Currently the company has an S&P credit rating of A-, and earnings per share growth from 2010 to 2019 grew at 13.8%, which is real good. Revenue, however, has been improving over the past 5 years at 2.6%. However, with the economic shutdown and such, revenue for 2020 is expected to be lower, but pick up in 2021. The net income has dropped tremendously over the past 5 years with only a growth rate of 14.6%. So revenue has been improving over the past 5 years. Net income, however, has been decreasing, but still double-digit net income growth. That's still very acceptable and very nice. Earnings for the 5-year average grew at 20.3%, so it's much better than the 13.8%. So earnings is growing at a better rate. And with that earnings growth, dividend has been growing very nicely as well, and we'll talk about this here. 2019 adjusted earnings came in at $2.75. Net margin at 28.5%, which is slightly less than 2018 of 29.2%, but it stays in that high 20s range over the past 5 years. Return on equity at 10.7%. It's been consistent in that range again over the past 5 years, a little less. It's been improving, so that's positive. Current dividend at 2.99%, so that's is a nice dividend. It's much better than the S&P 500 average index dividend payout. And the 5-year dividend growth rate is outstanding, 40.6% growth rate over the 5 years. So that's real great. And the most recent increase was 20% in July of last year, July 25th of last year, and they just announced a dividend, and I think July 22nd, but they didn't increase it. Of course, with the economic shutdown and the COVID and stuff like that, I'm okay with that because of the certain situation. So maintaining that dividend is much more important, I think, right now than increasing. But if a company is able to increase it, that's outstanding. But most company, the fact that they continue to pay dividends now is real understanding on their resilience and the management team and how they run the business. So that's great. And the dividend payout ratio is based on this year's earnings. And it's only 46%. So the dividend is very safe based on 2020 expected earnings. So that's real positive. And they've been growing dividends for 6 consecutive years. There was a stretch where, of course, with the financial crisis in 08, 09, they cut the dividends. And then slowly after that, they've been growing it. Charter rule, as you see, at 43.6 because of the 5-year growth rate of 40% and the current yield. And the 5-year yield average is 1.64, so you almost get a double the current dividend yield versus the 5-year average. So that's real great. I like that a lot. So look at the balance sheet right quick with some ratio. Debt to capital only 36%. The current ratio of 1.1, which is the current assets divided by current liabilities. So I like to see it at 1.5 and higher, which is like the recommended guidance for that. So this current ratio of 1.1 is based on the newest earnings report. Debt to equity ratio of 1.19 is not too bad. It's okay. I like to see it under 1 or further less. Price to book is very interesting at 0.87 versus the 5-year average of 0.98. So that might be an indicator that it might be undervalued. Same thing with the dividend yield. It's double. The current yield is double than the 5-year average, so it might be a good sign that it might be undervalued. And we'll look at that shortly. So look at future outlook for Bank of America. Analysts are expecting $1.55 for 2020 and 2021 $2.20. For context, 2019 the company earned $2.75. So 2020 expected earnings is 44% less than 2019's earning. Of course, this is because of the economic shutdown, and the biggest reason is because the provision for credit losses, which is 4 to 5 times greater than 2019's provision for credit losses. This is basically the company being ready to lose from people owing them maybe mortgages, credit cards, and things like that. CFRA is expecting earnings growth of 3% going forward for the next 3 years. And using my dividend driven return model analysis, I came up with 9.6% annual growth rate for the foreseeable future. Currently, the company has a PE of 11.7, and the forward PE, which I use based on 2021 earnings of $2.20, I have a forward PE of 10.9 versus the 5-year PE average of 13.5. So that's a good indicator that the company may be undervalued, and we'll see that shortly. So let's look at the fast graph for Bank of America. As you can see here, the company was following from 2001 to 2008 earnings quite nicely. You can see here it was at about 11 PE to 10 PE to maybe even 12 PE. But of course, when the financial crisis hit in 2008, 2009, earnings dropped dramatically, and so as the dividend. This was their dividend payout. It dropped also. So in recent years, 6 years growth rate, they've been growing the dividend quite nicely. And earnings is again following the price is following earnings again. So if we look at the 7-year, last 7 years with the expected 2020 and 2021 and 2022 earnings, it looks quite promising actually. If we look at Friday's closing price and base it on a PE of 13, we have an expected total annual rate of return of 21.3%. So that's very promising return. As you can see here, between 2016 and 2017, the company was slightly overvalued with a 15 multiple, more or less, 14 and 15. But 2018 presented some value with the PE of 10, where earnings grew much better. And you can see that earnings grew in 2018 43%. Last year only 5%. Again, negative 44%. But 2021 is expected to grow at 42% and 25% in 2022. So analysts are expecting the company to go back to where they were making $2 plus a share. So that's very positive. But something to consider also, the analyst scorecard is quite deceiving. As you can see here, analysts don't predict Bank of America quite accurately. However, for the past few years, they've been pretty spot on. So that's positive there. But from 2009 to 2015, they've been wrong pretty bad in analyzing or estimating their earnings. But in recent years, they've been pretty good with it. So that's something to consider with these expected earnings. So there could be some more or less misses as analysts haven't predicted Bank of America quite accurately. So let's look at the fair value prices for the Bank of America. CFRA has a fair price of $26.27, Morningstar at 28, FastGraph at $29.62, Yahoo 28, and my dividend discount model analysis at $27.83. I use a 10% dividend growth for the next 3 years and 7% after that with a discount rate of 10%. So that's how we get $27.83. Averaging out the 5, we get a fair price of $28.05. And currently, as of this presentation, the company is going for $24.07. That means the company is undervalued by 16.5%. And for that, I have a recommendation for Bank of America at buy at current prices. So I just saw I have a buy recommendation for Bank of America. I actually own shares of Bank of America. I have about $1,000 worth of shares. It's not tremendous like the 800 million that Warren Buffett bought, but I do own some shares of Bank of America currently. Of course, with the economic shutdown and all the things going on with COVID and things like that, the earnings are expected to be lower this year, but for 2021 and 2022, it's expected to be much higher. So that's where the return is expected. The 5-year dividend growth rate is outstanding, as you saw, 40%. The current yield is very nice at 3%, so that's a nice yield. It's much better than the S&P 500 current yield. As you saw, the company is undervalued by 16%, and it's actually a little less as of this video than what Warren Buffett paid for. So that's positive. So you may buy it at a better price than Warren Buffett did. Again, there is some risk with any investment, but with Bank of America, as you saw, analysts haven't been correct for the most of the time. They've been wrong almost more than 50% of the time. But I see it myself that the company is going to grow earnings. Revenue was growing very nicely. Net income was growing nicely the past 5 years, 3 years. So they're in that uptrend. So that's very positive. Just the economic situation that's happened is caused earnings to fall drastically. So I think Warren Buffett did a good move here. He bought shares of a company he already owned at a discount. And so I think you should definitely research more of Bank of America and determine if you should buy shares. If you own other banks, let me know in the description. And if you're planning to buy shares of Bank of America, let me know in the comments. Thank you for watching, and make sure to check out that free ebook that I have in the description. And if you're new to the channel, make sure to hit that subscribe button, and I'll see you guys in the next one.